Hello and welcome to the lecture for week 2. In this lecture, I'm going to start out by talking about the accounting cycle, all the steps we go through from recognizing a transaction that's occurred through closing our books at the end of the year. So we'll talk about that. We'll cover specifically this week the first 4 steps of that cycle, which include analyzing business transactions, recording journal entries, posting those journal entries to the general ledger, and finally preparing a trial balance, in this case an unadjusted trial balance, so it doesn't contain some of the adjustments that we'll cover next week. I'll stop at several points and ask you to work on portions of the in-class practice, which you will also find on Canvas. So the accounting cycle starts with identifying and analyzing transactions. And I would also add the word capturing transactions. So different events take place in our business. We receive invoices from suppliers that have provided us with services. Employees do work and we need to recognize the expense and the liability associated with that. We bill clients for work we've done for them. We receive cash. All of those are financial transactions that occur in the business. So we analyze those in the sense that we ask ourselves, what is being affected? So which categories on the financial statements like assets, liabilities, or equity are being impacted? Are they increasing or decreasing? And then how do we record that using debits and credits? So the next step is then to record each of those transactions using debits and credits and account names in a journal. That journal is then posted to the general ledger. It's not enough to have a chronological list of all the transactions that happen in a business. We also need to know what our ending balance in cash is, as an example, or what our total salary expense is, or what the total amount owed to us by customers would be. So by posting portions of those transactions to their relevant accounts, we can summarize or total what the impact of those transactions is account by account. Once we've posted all of the entries to the ledger, we can then prepare an unadjusted trial balance, which is a listing of all the accounts and their ending balances, debit or credit. The next step in the process is to create adjusting entries, which adjust those transactions to kind of more accurately tell the story of what happened in the business. We then post those adjusting entries to the ledger and create a new trial balance which reflects those adjustments. That is then the basis for preparing financial statements. We complete that process 1 through 7 every single month. When we get to the very end of the year, we record closing entries, meaning we close our revenue accounts and our expense accounts to retained earnings. So we kind of wipe the slate clean so we can start on the first day of the next year recording new transactions. We don't want to carry over our year-to-date amount for rent expense, as an example, into the next year. We want to start fresh. We then prepare a post-closing trial balance to make sure that we've closed all the accounts that we should have and everything is as it should be. Some companies will use reversing entries to make bookkeeping a little simpler. We won't get into that, and then we start all over again. So journalizing is how we record a transaction that we either learn about or have a source document for. So that process is called journalizing, and we record a journal entry in a journal. So the steps in transferring what is a written or verbal description of a transaction into a journal entry that other people can understand and that a computer system can understand, we follow these steps. First, we carefully read the description of the transaction and determine which categories, assets, liabilities, equity, revenue, and expense, or the drawing account if people are taking money out of the business, which one of those accounts or categories is affected. And then we determine for each account, is the account going up or going down? If we're receiving money, our cash account is increasing. If we're spending money, our cash account is decreasing, as an example. Then we go back to our rules of debits and credits, where everything to the left of the equal sign increases with a debit, everything to the right of the equal sign increases with a credit. And we use those rules to decide how do we record an increase or a decrease in any particular account, and then we record the journal entry. So the format of that entry is fairly accepted and traditional throughout accounting, so it's important that you kind of follow these rules. First of all, we enter the date in the date column, the month being recorded with 3 alpha characters. We don't need to repeat that month if it's another transaction within the month. We would just, in an example here, put the 29th if there was a transaction the next day below the 28th and record the next transaction. We'd only write the month in again if the month changes or if we go to a new page. Then in the description portion, we start always with debits. We record the debit first all the way to the left side there, in case supplies, and then we enter a figure under the debit column. Notice here it doesn't have a dollar sign. This is an internal working document, so we keep it as simple as possible. We'll come back to the post-ref column later in the lecture. We then record the credit. In this case, it's a credit to cash. Notice it's indented about 4 spaces, and then we record the credit under the credit column. We always want to make sure that our debit column and our credit column equal each other. We then record, you see in italics there, some description of what happened in this transaction. I won't ask you to do that in our in-class practice or homework just because it's fairly time-consuming, but in the real world, it's a very, very good idea to include a description of what it is that you're doing with that transaction. The reason for that is you may leave the organization, you may retire, whatever the case is, somebody coming along behind you, it helps them immensely if they can see why you recorded what you did. Secondly, it helps you remember. You might have recorded a transaction a year ago and you can't remember why exactly you did that, and it can help you as well. So a lot of transactions in business repeat themselves over and over again. So here's kind of a nice cheat sheet. You might want to print this in full size for common transactions that happen over and over again in almost every organization. So receiving cash for services provided. We do work for somebody, they pay us in cash. So in that case, we're going to increase the asset, cash, with a debit, and we will increase fees earned, our revenue, with a credit. Owner's equity increases with a credit. Revenue is increasing owner's equity, so it increases with a credit. A slight variation on that is we provide services to a customer, but in this case it's on account. They're going to pay us later. In that case, the asset that we debit to increase is not cash, but accounts receivable. Of course, the credit is the same. When we later receive a payment from that customer that we had billed previously, 2 assets are being affected, cash and accounts receivable. One is going up and one is going down. After this transaction, we have more cash, so we debit cash. We have less accounts receivable, fewer people owe us money now, so we decrease that with a credit. If we increase an account with a debit, we decrease it with a credit. Next, we purchase an asset on account. So we debit the asset account, maybe that's supplies or something like that. And that word on account means we're going to pay for it later. So in this case, we credit accounts payable to increase the liability. When we later pay that liability, we're going to decrease the liability with a debit. Again, if we increase it with a credit, we decrease it with a debit, and we decrease cash with a credit. Lastly, if we pay cash for either an expense or an asset, we will increase that account with a debit, either the asset or the expense account, and we'll decrease cash with a credit. Don't need to worry about the bottom 2. If you could go ahead and hit pause and take the first in-class practice sheet, it's for Oli Hot Yoga, and do the journal entries. So just do the journal entries and stop, and then compare that to the solution. Okay, so I want to show you what doing a journal entry in Dynamics looks like. So this is a typical input screen in Dynamics for recording a journal entry. The majority of journal entries that are recorded in accounting systems occur through different modules. As an example, if I'm in the module for recording cash receipts, I'm going to be entering cash receipts, receipt numbers, dates, customers that the receipt came from, dollar amounts. I'm going to be entering that information on an input screen. And I might do that all day long for a whole bunch of cash receipts. In that case, in the background, Dynamics is debiting cash and crediting accounts receivable and updating the ledger for those particular customers. So it's recording those entries in the background. You're not doing that in a journal entry. So in accounting systems, journal entries are really intended for correcting entries that really can't get into the system through a regular journal. They're unusual in some way, or adjusting entries. And usually entering an adjusting journal entry like this is limited to a small number of people, because if a lot of people can do it, you can get a real big mess in a hurry. So you can see it auto-populates the journal entry number so that we have a specific number associated with each entry. It auto-populates the date as the current date, and then you can see down below we can enter account numbers and dollar amounts for debits and credits. It won't let us post this or move on if it's not equal. Notice it also provides an audit trail code that allows us to trace from the general ledger back to who did the entry and why they did it. So the next step in the process is posting to the general ledger. So here is a written description of how you do that. So you enter the date in the date column of the relevant account in the ledger. You record the debit or the credit for that transaction, and then you update the running balance column. You write the journal page number that it came from in the post-ref column of the ledger, and then back on your journal, you write the account number for where you posted that entry to the ledger. That allows you to trace from the ledger to the journal, the source where the entry came from, and it allows you to trace from the entry to the ledger where you placed that entry. So in this case here, we have a general ledger for a cash. Imagine a general ledger is like a binder where you've got a page for each account, and we've gone to the cash page. It's account number 11 for this company. They had one transaction on December 1st where they received $10,000. So that is entered in the debit column you see kind of roughly in the center of the screen. And then this must have been a brand new business because they had no preceding balance, so they have a running debit balance of $10,000. Then on the second, the company has a credit to cash, so they spent some money, $2,400, and that lowered the running balance to $7,600. So we're very rarely going to have a balance in the credit column for cash. Usually the balance that we'll have for an account will be in the column that is associated with the normal balance for that account, the side that increases. The key to doing this is to be methodical, to take transaction by transaction, post the debit, post the credit, move to the next transaction. Putting a 1 or a 2, the page number in the post-ref column on the ledger, and then putting the account numbers on the journal is a good way of kind of checking off that you've done something and keeping track of where you're at. So now go ahead and hit pause and post the journal entries that you did for Oli Hot Yoga to the general ledger pages, and then check your answers against a solution, and then come back to this lecture. Here's an example of a detailed ledger for in Microsoft Dynamics. So this in this particular company is for the cash account, and what you're essentially printing is a detailed trial balance for just one account. So it's showing, you can see in this case it's 83 pages. So it's showing all of the transactions that hit that general ledger account for a specified period of time. They're doing it for an entire year. All of the transactions that you see here are debits to cash. So it's cash receipts occurring. What you're really going to use this for is when an account has a balance that doesn't make sense. Maybe you've got an accounts payable account that you're looking at, and the balance is a debit balance and it should be credit. So that doesn't make sense. So you would print this out and you would scan through there and you would see a lot of ordinary transactions like you see here. And hopefully you'll see one or two things that maybe stand out as being they don't belong. So for accounts payable, everything should be entered through the purchases journal and it should be paid through the cash disbursements journal. So I would look for transactions that weren't from purchasing and weren't from cash disbursements to be the likely culprit of why it's off. Finally, we'll take the balances that we have once we've completed the general ledger posting. We'll take the ending debit and credit balances of each of those, and we'll prepare an unadjusted trial balance. So that is a listing of all the accounts with a non-zero balance and whether the balance is in the debit column or the credit column. It can be very useful in discovering errors, for example, comparing total debits to total credits to make sure everything has been entered correctly before you go on to the next step. So here is an example of an unadjusted trial balance for a typical company. So you can see all of their accounts starting with assets, then liabilities, then owner's equity, revenues, and finally expenses. So it's in account number order. And we've got the debit balances listed under the debit column and the credit balances under that column. And what's critical is that they equal each other. 42,600 equals 42,600. So go ahead and stop now and create an unadjusted trial balance from the balances in your general ledger. So here's an example of a summary trial balance. So now I'm not looking at a detail of every transaction. I'm just seeing the ending balances in accounts for a particular company for a particular period of time. This is one day in August for this company as an example. You can see here that the debits equal the credits. The beginning balance is 0, which tells me that the opening balances of debits equal credits, and the ending balance is 0. So all is good. Notice that debits are recorded as positive numbers in the balances and credits are recorded as negative numbers in the balance. So that's kind of an important thing to note there. Now sometimes you'll end up with a situation where debits don't equal credits and there's a problem to be solved or an error to find and correct. So a couple of handy tips for how to find errors. So these are for finding errors that result in the two balances not being equal to each other. So one, if the difference is divisible by 10, 100, 1,000, etc., look for an addition error. So you added numbers on your general ledger and you didn't add correctly and transferred an incorrect sum. Look at the difference between the two numbers. If it's divisible by 2, so divide it by 2. If it's an even number, divide it by 2. And if that number is one of your account balances, that may be the culprit. You may have entered a debit as a credit or a credit as a debit. If the difference is divisible by 9, so if you take the difference between your debits and your credits and you get a number like 450 or 90 or 630 or 7,200, then it's likely that you've transposed some numbers. You've switched the order of a couple of numbers, which is really easy to do. Lastly, if the difference between the two is the balance of a particular account, you may just have omitted that when you prepared your trial balance. You just didn't include a particular account, you left it off. That could also be a reason. There are also errors that are problems that we want to find when we look at this trial balance that aren't necessarily causing an unequal balance. So we may have accounts that have balances that are different than their normal balance. So they're different than what they should be. For example, we may have office equipment with a credit balance. That's impossible. We can't have negative office equipment. So we would want to dig into that, find out what went wrong, and then correct it with a correcting journal entry, post that to the general ledger, prepare a new trial balance, make sure that error is not present any longer. I might have a liability with a debit balance. That may be also something that kind of shouldn't smell right. It should say something is wrong here. I may have expenses or revenues that are unreasonably high. If my rent is $1,000 a month and I look at rent expense and it says it's $60,000 for the year, well, something probably got put into that account that shouldn't have been. So I would go back, look at the general ledger detail for that account for rent expense and see what posted into that, and maybe find the entry that was posted in that should have gone somewhere else. Then I make a correcting entry and again do the process over again. So for next week, please complete the brief homework assignment that I have that you can find on Canvas. Read sections 4.1 to 4.2. These are concept and guidelines that affect adjusting journal entries, and then look at the adjustment process and the common types of adjusting journal entries. And that's what we'll focus on next week. So thank you for your attention. I look forward to talking to you in the next lecture.